All right, welcome to the Enterprise Group Business Breakdowns. Before we get started, I just want to remind all participants the purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, members, subscribers, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. I want to thank the Microcap Club community for tuning into this Business Breakdowns conversation with Desmond O'Kell, CEO of Enterprise Group. My tag team partner for this Business Breakdowns is Jesse Gamble. Jesse is a senior VP and portfolio manager at Donville Kent Asset Management and has been working at Donville since 2011. Jesse has also been an MCC member since 2019. Guys, welcome to the Business Breakdowns, and thanks for doing this.
Yeah, appreciate the invite.
Yeah,
Thanks,
for having me.
If you're interested in learning more about Jesse or Des, we'll put a link in the show notes to their work. And again, thank you guys for joining the Business Breakdowns. The business we are breaking down today is Enterprise Group, which trades on the TSX under the symbol E.TO, along with on the over-the-counter in the US under the symbol ETOLF. Enterprise Group was originally profiled in January of 2024 by James E. Enterprise Group is a leading provider of specialized equipment and services to the energy, pipeline, and infrastructure industries and is positioned for significant growth. Based in Alberta, Canada, Enterprise operates through 4 divisions: Evolution Power Projects, Westar Oilfield Rentals, Arctic Therm International, and Hart Oilfield Rentals. With a strategic focus on natural gas-related services, the company benefits from its competitive positioning and growth opportunities in the Canadian energy sector. Enterprise Group's services are closely tied to the natural gas industry, specifically in Western Canada, where the company operates. Western Canada is a key natural gas producing region, and its industry is poised for further expansion due to the ongoing development of liquefied natural gas facilities. With the anticipated increase in LNG exports, Canada is set to become a top 10 LNG exporter by 2028, creating a strong tailwind for Enterprise Group's growth. Again, Des, thanks again for joining us. And before we get into your presentation, I'd love to just hear more about your background. I believe you've been involved with Enterprise Group since the early 2000s, so it's quite a long time. And I'd love to just hear, on a personal standpoint, maybe what brought you to the company and anything else you'd like to share.
Yeah, certainly. Well, actually, yeah, we're in our 20th year in business at Enterprise. Actually, I'm the president of Enterprise. My co-founder and partner is the CEO of Enterprise, Leonard Jarozik. So we started Enterprise back in 2004. It was the very first $2 million CPC, Capital Pool Corporation. They increased the from I think of $500,000 to $2 million, and Enterprise was the very first $2 million CPC. We spent a short period of time in the early years, building the business. We made 3 acquisitions and quickly graduated to the TSX in 2007. Obviously, we've been exposed and active in the energy services world. So, we've seen our fair share of ups and downs in that 20 years. So basically, where we are today after many of these gyrations, certainly in the Canadian energy economy, and it's really important to note because we feel what might be a little misunderstood here is the change in where we are in Canada as a significant producing country. The majority of our existence in the energy economy here in Canada, our only client or our only customer for oil and gas was the US. Just in the past year, we've had a significant piece of energy infrastructure opened up to the West Coast with the Trans Mountain Expansion Line being commissioned in May 1st of just last year. That's transporting, almost 600 barrels of oil a day to a deep port for access to certainly the Asian markets or the global world markets. But further than that, we're about 4 or 5 months away from from the very first LNG cargo that is built and complete. They're almost going to be ready to ship their first cargo. Like I said, probably mid this year, which is headlined. It's LNG Canada. The primary player in that is Royal Dutch Shell's Canadian Shell Canada. There's four Asian partners in that: Mitsubishi, Korea Gas, PetroChina, and of course Petronas, which is a Malaysian outfit with substantial producing operations here in Canada, and they are a client of ours as well. So this is on the LNG side. This is an absolute needle mover for obviously the Canadian producers now that we've got oil and natural gas access to the global markets, something we haven't had in any scale before. And this is going to be, you know, certainly a take away the lumpiness that our industry has seen in the past with just having the one customer. Obviously, we've got these tariff issues and what have you, kind of in the background and so forth. More and more infrastructure going to our coasts is very valuable to the marketplace. And I think if we get a change in administration here in Canada, I think you'll see enthusiasm for more of that. Why isn't our sorry here? I'm just going to get the thing going here. So I'll get right into the deck here. I'll try and keep it modest in time for the purpose of fitting everything in and a good question period. But we are a leading provider, as Adam mentioned, of mobile site infrastructure and services to our Canadian resource energy sector. Over the past few years, we've been increasing our revenues, and not only that, being increasing our margins as we've been developing some of our new product offerings that I'll get into at some length here. As you can see here, we've got a few graphics here. We've been increasing revenues. We're a market leader in our particular space. We've been expanding margins, and of course, important to note that insider ownership is just under 30%, even with the most recent raise that we've accomplished. So we possess this leadership in our infrastructure to the Canadian energy sector, and of course we have this current advantage of being the sole provider of low emission site electrification systems to our segment. We're going to talk at some length about that. We're remarkably profitable with substantial margins, and we're in a rapid expansion trajectory. We're a provider to the most reputable and sizable producer clients in the sector, and we are in favorable trends in our energy market with avenues to venture into some new markets we'll talk about, and this will foster considerable expansion organically and via M&A. We have a very healthy balance sheet and liquidity, and this will facilitate our strategy for continued growth. As I mentioned, management and insider ownership is now right around 28%, so there is a history of significant insider buying and share buybacks. We had an NCIB program that was very active over the last few years. We've purchased back and canceled at the time about 20% of the company, so almost 11.5 million shares. And of course, we're guided by a seasoned leadership team with a track record of effective strategic implementation, savvy downturn navigation, and we have a fervent dedication to enhancing value for investors as we are shareholders ourselves. These are the four companies that we're operating in the field with, but generally speaking, we are a site infrastructure provider through these four businesses. We're going to talk a little more at length about Evolution Power Projects because of our absolute leadership position that we have in our mobile power systems to the industry. This is a smattering of some of our clients. Many of these are going to be very recognizable to the audience. It's not a complete list, but these are companies that we're working for in the field every day. So with respect to Evolution Power, and I want to explain what the equipment and the services that we bring to our clients, which are the producers, they are performing their projects out in the very remote areas. These projects could be anything from building their gathering system plants. They could be drilling, completing and fracking their wells, tying in, of course, all their production. All of these projects are 24/7 operated projects in very remote areas away from any type of infrastructure. So to operate 24/7 for the length of these projects, which sometimes can be several weeks in length to several months in length, they need to be able to operate 24/7, so they'll need mobile power systems to site. And we're going to talk at length about that. They're also going to need mobile structures out on site. Usually these sites require anywhere from 5 to 10 mobile structures. They could be offices, command centers, medic buildings, washroom buildings, and so forth. But all of this infrastructure and mobile structures needs to be on site for the length of the project. Because these sites are 5 and up to 15 acres in size, they require lighting. So stadium style portable lighting on these sites. Lighting is on 24/7, whether it's night or day, or if it's January or June, lighting is always on. And it's important to know that the power generation historically or traditionally has been diesel powered power generation on site. So multiple generators are on site operating 24/7. At the bottom of every light tower, you'll have a 6 to 20 kilowatt diesel power generator that powers that light. Well, we might need 6 to a dozen of those light towers on a site. So there's multiple diesel units operating. Of course, all of the buildings and ancillary power needs of the client on site will need to be there. So there'll be 150 kilowatt units powering buildings and other ancillary power needs. So there's a good deal of diesel power on site, 10 to 20 generators at once. And of course, the consumption of diesel fuel is in the thousands of liters or gallons a day. So what we've been doing over the past number of years is we've been retooling our power fleet, our mobile power fleet, to operate natural gas power generation. Specifically, we've been developing our fleet and building our fleet around the flex energy turbine technology, which you can see in the photo here. The reason why we've settled on this particular unit is because we are in Canada, much of it to the north, and the conditions that we operate in are extremely they're extreme conditions. I mean, we're in the middle of winter right now. Just 2 weekends ago, we experienced minus 52 degrees C on a site in northeastern BC. What's important is that even in these extreme conditions, the equipment needs to be robust enough to operate. Now, this particular turbine technology thrives in the cold, and we had absolute 100% uptime through this cold spell, which has lasted several weeks here. So it's important to develop reliable equipment and robust equipment for the conditions that we're operating in for the client. One of the reasons why we've been retooling away from diesel to natural gas is because the majority of the producers that we're operating with are gas producers. So there's an opportunity to utilize the client's natural gas to fuel these units rather than the client having a fuel distributor bringing vast quantities of diesel to these remote sites every day or every second day. So if there's an opportunity to use the client's gas, they have the opportunity to absolutely remove that expense from the project site because they pay no one for their own fuel, obviously. On sites that there may not be the logistics to utilize the client's natural gas, we would utilize compressed natural gas, CNG, which is a 60% savings from diesel. I've got a slide that shows some costs. We'll eventually get to that. But in this site infrastructure segment that we are in, we have not really had any significant competition with any type of natural gas, low emission electrification equipment competing with us. So we've had a few years of an ability to build this moat further around our offerings. And one of those particular fortifications around the moat is we're able to sign an exclusive arrangement with Flex Energy of the U.S., the manufacturer of this turbine. So for project to project style activity, we are the only player that can access and utilize the Flex turbines in Western Canada. We've been building a relationship with Flex, and there's more to come on that. We're developing some more. There'll be more developments in our ability to get that exclusivity expanded further, and that's work in progress. But right now, where we are in the energy sector is we're just at the thin edge of the wedge. We feel we're about 15-18% of the captured market in the energy sector of getting the natural gas turbines onto these sites. So we're bringing our systems wherever they're operating with diesel, traditional diesel situations. There, we can displace that with these natural gas systems, and we feel we're at the very thin edge of the wedge, 15-18% of the captured market. So we have lots of runway in front of us. And of course, there's also, we'll talk about some opportunities in some adjacent industries like mining and other temporary power needs and so forth. But essentially, we have a growing turbine fleet, and our natural gas systems are in the 30 range total. What we do is we also have an associated microgrid, because I'll just explain with some graphics here. You can see this is a graphic of a typical, in this case, it's a drilling site. And of course, you can see our site infrastructure around it. You can see the light towers. There's several light towers around the area. You can see the mobile office structures in the back right here. Obviously, they're in most situations that you'd see 5 to 10 of those 60-foot structures in location. Of course, you can see the natural gas generators and the backup units, and of course the distribution panels and cabling. This is the microgrid that is distributed around the exterior of the site, where all of the infrastructure seamlessly plugs in. So we have a very, very clean footprint. And obviously the noise level of, removing 10 to 20 diesel generators and replacing it with one larger natural gas, relatively quiet in comparison turbine, the volume level drops dramatically. But what this gives to the client is not only this opportunity to cut their costs dramatically on the fuel costs. When we move from diesel to natural gas, there are massive emissions reductions when we move from diesel to natural gas, and we'll get into a little bit of that. But obviously, when we're talking about removing the handling of liquid fuel like diesel, that handling is completely eliminated as well. So there's some safety aspects to this natural gas to electrification. Once we've connected the gas source to the unit, there's absolutely no more fuel handling. This is a bit of a chart that we can show you that in the cost of comparison of equal size or similar sized diesel generator to our gas turbine. Now we've got three scenarios here. On the left, we've got the diesel generator. That 350 kilowatt at full load will consume about 2,400 liters a day. At $1.60 a liter, that's almost $4,000 a day of fuel costs to the client. Over a 3-month project, about $345,000 in fuel costs to the client. Now we have two scenarios over here. If we're utilizing the client's natural gas in the field, which is more than 80% of our particular project sites, they pay no one for that fuel. So obviously their total fuel costs are really zero. So there's 100% savings opportunity there. In areas where we don't have the logistics to use client field gas, we would utilize compressed natural gas. There's some industrial mobile vessels that are available for compressed natural gas. And as you can see here, our gas turbine utilizes almost 75 MCF a day at $21 an MCF. Gas prices fetch a daily right around $1,570. So CNG cost for a 3-month project at 141. So almost a 60% savings in fuel costs when we utilize compressed natural gas. So there's a fantastic arbitrage opportunity here on the cost savings. But further than that, when we move to the same two generators and we look at the emissions reductions that we can deliver to the client, you can see these pollutants here: particulate matter 2.5 and 10, SOx, NOx, volatile organic compounds, and carbon monoxide. You can see when we move over, these are not very simple reductions. They're massive reductions, 85 to 99%. In the case of SOx, it's a 100% reduction when we move to natural gas from diesel. So these are very valuable emission reductions. Here in Canada, we have some legislation that's been around 3.5, almost 4 years, that is, nicknamed the Heavy Emitters Act. And basically, if you're an industrial operator and you're producing 10 kilotons of CO2 equivalent, you're bound by the obligations of this legislation to monitor, track, and report your emissions. If you're over that threshold, you would pay carbon credits to flatten yourself out to that threshold. If you're under, you're able to earn carbon credits. Now, here in Canada, our government some years back valued a metric ton of carbon at $70. It has now been increased to $80. On April 1st of this year, in a month and a half away, it goes to $95 a metric ton. Eventually, in that plan, finding its way all the way to $170. So there's a financial incentive for these larger tier 1 clients of ours that are caught up in this legislation to reduce their emissions, get them under that threshold, earn carbon credits at $80 and $95, knowing that in the future they'll be worth $170. So there is a financial opportunity for the clients to be utilizing our power mix, which we can deliver these pollution reductions for them. Any questions? I've been speaking a lot. Is there any questions along the way here?
You can keep going or wrap up if you'd like. We can start the
Okay.
Q&A process. It's up
Nope.
to you.
I'll continue on. I just want to look at a little bit of the last 4 years of financial performance. You can see here, we came out of a 7-year downturn in our energy sector that lasted right up into the middle of 2021, and then the Canadian energy economy really started to get far more active since 2021, and including 2025. The majority of our Canadian producers have been increasing their capex year on year since 2021, and again in 2025, the majority have upped their capex spending again. So we're still in this market trajectory, but you can see here not only is Enterprise increasing their revenues across the last 4 years, we're improving our margins. Now, there's a number of reasons why we're improving our margins, but one of them is the more and more natural gas systems we put out there, because this microturbine technology is 99.5% uptime, we're not dealing with the maintenance of those units while they're on site. It's our obligation at Enterprise to make sure the client site is running properly with our equipment. So our field techs are out to site in these remote areas dealing with issues. When we move from diesel power systems to natural gas power systems, the need for our field techs out to site drops dramatically. And one of the reasons is, a diesel fired engine every 500-600 hours needs to be just like your car vehicle. You need to get a oil and filter changes and fluid changes. So you got to stop the unit, do that service. That service takes a few hours, and then we're back up again. A micro turbine or a turbine technology, the maintenance intervals are in the thousands of hours, like 10,000 hours. So we will never shut down a a turbine on site to do a maintenance interval. We would always wait till it comes back to the yard and shop to deal with that. So it is 100% uptime, like I mentioned before, robust enough to deal with the minus 40s and minus 50 degrees C. And of course, what I haven't talked about, and why this is one of the leading technology in turbines, is that it has tremendous fuel tolerance. What I mean by that is these turbines, when we're utilizing field gas or flare gas or solution gas, this is gas that is not purified, it's not been refined, so it's not perfect. Our flex turbines are able to operate and deal with that kind of imperfect fuel. And of course, because we're using field gas or sales gas in the field, it is absolutely critical that you're able to consume that type of gas. All these other types of technologies, we have another technology. We've got 6 of them in the fleet, and they need absolute perfect fuel. And of course, they have problems when you get past about minus 18 degrees C. So that's why we've been building the fleet around the flex unit, because of significant fuel tolerance and robustness in all of these extreme conditions. I'll float through a couple of the last few slides just to give a bit of an indication. Obviously we've got a 52-week high of 80 and 269. We're 77.5 million shares out, so market cap around 188. With our cash position in the till right now at about 27.5 million, brings our enterprise value around that same value of 188. We have a total net adjusted net equity of our equipment right around 76 million, which is $1.24 a share if we were to just liquidate the equipment. So you can see where we are in this particular snapshot. So where we are today, and to summarize for the deck here, we've achieved this leadership position in our industry segment, boasting significant profitability with substantial margins, resulting in robust cash flow. Our Canadian energy landscape is experiencing rapid expansion, with investments in LNG serving as a significant growth driver. Important to note that the majority of our clients have some kind of feedstock obligations of their production going into LNG Canada's new project. It's an absolute needle mover. That project alone in phase 1, once it's on shipping cargoes, is going to take away 15-18% of Canada's natural gas production. And we have 3 other natural gas facilities at different stages of approvals or construction. So we have a much more significant LNG footprint here going forward for Canada. And as I said, it's a real needle mover for our clients and ourselves. So this escalating demand for equipment, skill, labor, and expertise has also improved our pricing over the last few years, which adds to that ability to generate those kind of margins. Our robust balance sheet and healthy cash flow will underpin our current expansion strategy. And of course, we're guided by a seasoned and deeply dedicated management team. So that kind of gets us through the end of the deck, so we can get into Q&A if we want.
Excellent. Thank you very much. That was very comprehensive. I really appreciate that. I'd love to start off. You talked a lot about, well, I'll say this. Your solution seems like a no-brainer for your customers and potential customers. And I'd love to just get into customer displacement if you can. What have been the hurdles or challenges for you to do that? And maybe you can just talk a little bit about your sales process and how you kind of get new customers over the finish line, if that makes sense.
Yeah, no, absolutely makes sense. And why that question is valuable is not everybody adopts something new, regardless of the features and benefits at the same speed. Some have adopted very quickly. Some need all types of technical issues answered. Obviously, to deal with the client's natural gas in the field, there's some logistics that need to be taken care of. So there's got to be an appetite to deal with some of that. It's really not much to overcome. But nevertheless, these things have to be dealt with on a technical level. Usually, we're dealing with the company's internal uh, uh, engineering expertise and so forth. So there is a balance of how we get an adoption over the finish line, and they're not all equal. We also run into where many of the field operators, they're not company people, they're consultants. So sometimes we have to and those consultants, not all the time are they interested in changing anything, especially something they've been doing for maybe a couple of decades. So we've done some business development restructuring. We've never really had exposure to physically the C suites, and we feel that if we get to sit down and properly present our solutions to the C suite, it's a quicker adoption. So in the past 5 6 months, we've hired a technical person that has heavy experience in our sector. He has I call it a trap line. He knows people in the sector, so he comes with relationships, and we've been seeing some terrific early successes from that, because most of our development has been out in the field, business development, and of course we need both. And with something like our power division, also our heating division, which is very technical, we're dealing with engineers. We need to have that kind of competent technical presentation in the downtown of Calgary, and of course, as I said, we've achieved that here recently. So it's changing our ability to get the sales over the line. That's for sure.
Great, thank you. Yeah, it sounds like the user of the product is kind of removed from the buyer, making the sales cycle a bit longer. Sounds like that's what you're saying a bit.
Yeah, as I said, there can be a lengthy sales process, and sometimes it's much quicker. We have a large international player in working here in Canada. One of our more active clients. They were looking for an opportunity to do exactly that, utilize their own gas on site. They were looking for, in their own capabilities, how they would do it. We had this is early on in our movement to the natural gas systems, and we had our field techs were out on site mobilizing and setting up a new project. And on the way back, it's sometimes 3 hours up in the middle of nowhere. And they stopped off at one of their sites to deal with an issue, and they said, "Hey, we just set up one of our first natural gas systems." And he explained it to the consultant, which was a company guy on site, and he says, "We're looking exactly for that. That's a solution we're looking for." It went from in the middle of nowhere, northeastern BC, to the 21st floor of that Calgary Tower, and within a half an hour, a phone call to our branch level to order the next completion outfit to be natural gas. And so that's how quick that went. But they're not all like that. The sales process
Excellent.
can be, and everybody and needs to know all of the technical details and what have you. Sometimes that can be drawn out.
Understood. I'll ask one more and then I'll pass it off to Jesse. So I'm curious for the maintenance and service component of your product. So can you just walk me through kind of the flow of dollars there, and maybe if that's something you can pass along to the customer, or do you primarily handle that sort of thing?
Well, specifically to the turbines, because they're a bit of a different animal in our fleet of our whole asset mix. Um, because it's a turbine technology and there's some IP there, all of our turbines we purchase a OEM maintenance package from Flex. They have the turbine technicians in house, so they do all that work. Um, and that maintenance package that we pay annually for is passed on to the client. So it's a little bit different than, let's say, some of the mobile structures. We own them. If there's maintenance, I mean, these mobile structures, they're like offices and homes on the inside. So, after 5 or 6 years, you might be, replacing the appliances in them or redoing the flooring or whatever. We obviously look after that. That's a maintenance part of maintenance. So usually our maintenance capex is usually a couple of $1 million a year on our assets. Okay, but specifically to the turbines, it's all looked after in this OEM service package that we purchase.
Excellent. Thank you very much. I appreciate it. Jesse, the floor is yours.
Thanks, Adam. Thanks, Des. I'm just going to jump back to the competition turbines. So I know you've tried some in the past. You own another brand.
Yeah.
I think it would be helpful for people to understand, like, are there one or two other competitor turbines, obviously, that don't work in the same way, or are there 100? Like, can you break down the type of mobile turbines out there? Because obviously turbines, there's extremely large, extremely small. So maybe just break down where your niche is and what the competition looks like there.
Right. So when you hear the nomenclature microturbine, that basically is a half a megawatt or 500 kilowatts and down. And many of our, like all of our turbines in our fleet are sub 500 kilowatts. So these are genuinely microturbines. Now, these microturbines, there's really only three manufacturers in the world of these microturbines. In multiple megawatt turbines, there are a number of them. There's Siemens, there's General Electric, there's Rolls-Royce, there's a number of them. Mitsubishi, and of course, the gas turbines that are operating large electricity utility facilities. Those tend to be 35 to 150 megawatt turbines. They are massive. They're in a league of their own. They need perfect fuel. Most all of these other turbines, they need perfect fuel. The only wide fuel tolerance turbine is the Flex unit. Now, it's important to note that Flex also builds a 2 megawatt unit on the same platform. We don't have any in our fleet, but I will definitely tell you that they will be in our fleet in the near future because of the applications that we're looking at in the expanse of our business. It's also important to note that this Flex Energy turbine platforms, these units can be synced together in multiple units. So our 333 kilowatt microturbine from Flex, we've had many situations where the client needs 1.2 megawatts. Then we'll put 4 units, sync them together. They act. They call them acting in parallel or stacked. So we can make 1.2 megawatts out of 4 units, and the units are acting as one power plant. So we can link together multiple units, and the 2 megawatt unit, same thing. We can add a 333 onto it, or we can add multiple 2 megawatts. So if there's client needs of multiple megawatts, then we can look at fortifying our fleet with the 2 megawatt unit.
Yeah, that's so. Speaking of Flex, there was a Canaccord's horrible report out yesterday, but we maybe get into that in a second. But they mentioned Flex's ability to supply your demand, and so maybe just speak to how Flex literally just moved into their new Denver facility and their ability to supply your demand.
Yeah, well, I'll give a 30-second history on Flex. So if anybody out there is familiar with the name Ingersoll Rand, it's a Fortune 500 American company with uh, decades of history. This patent and this intellectual property of that is now Flex, that was a division of Ingersoll Rand. Now, about a decade ago, they spun out a number of not what they would call non-core technologies or businesses out of Ingersoll Rand. If anybody is a golfer, you'll know Club Car, the golf carts. That was an Ingersoll Rand division that was spun out in the same era as well. The Flex technology was spun out to its existing owners now, which is a private entity, and that was about a decade ago. So they are now, back in the Ingersoll Rand days and after the spin out, they were located in New Hampshire. Well, the majority of Flex's activity was in the American and Canadian energy sector, which is more in the middle and south of the state. So when they looked at the new ownership looked to relocate, they wanted to be somewhere a little more logistically optimum to where their units were. So if anything needed to come back to the factory, it was going all the way up to the northeastern seaboard, and they just properly relocated the whole operation in just south of Denver, in a industrial suburb there. It's a brand new location with a brand new assembly area. They've got the ability to go to 5 lines. They are running 2 lines at the moment. They have a very robust domestic market for themselves that's upticking as well. So we feel that we were there in early November, and we were absolutely enthusiastic about their new facility and their capabilities.
And then giving us a kind of idea of the pace of EPP growth. So I think you mentioned you have roughly 30 of these turbines, and I know you're ordering more. And just as an investor or potential investor, what type of pace of growth do you kind of see in this market?
Well, the growth has been, just so everybody understands, the growth has been really developed by customer demand. We've been acquiring as the clients have been demanding, and as we're bringing on new names and converting existing clients from diesel to natural gas. We've really been building the fleet up here in the last couple of years. We have budgeted. We just landed 4 turbines here in end of December, early January. We have on order off the manufacturer's floor. We're looking at 10 coming at different intervals of this year. So that gets us in that 40 plus natural gas systems in the fleet. We feel that as far as I can see, and trust me, it's impossible to predict what the clients are doing and how we're growing. Fortunately, we've had, because Flex manufactures sells you their turbine units for permanent installations, and they also long-term lease the units. So we've had a standing order for the last couple of years with Flex that if any unit in their universe, both Canada or the US, a unit comes off of a long-term lease, we want the first crack at it. And we've actually, every unit in the past certainly 20 months that's come off of a lease, we've acquired it, and we've really needed it because it's dovetailed nicely with our demand. But this year we've got, because they just in the past couple of months started up the new manufacturing facility, we gave them an order for 10 across this part of the year. So we feel it should match up as best as we can predict the future with this year's demand.
And then not just talking about turbines, but you obviously have other divisions that you supply to these customers. So maybe just quickly on how the inventory level of all those other segments are to fulfill this demand, because obviously you're supplying multiple different activities to the same location.
Yeah. So we've got to let's face it. I mean, that's our sector is growing, so all of our businesses are exposed to some growth here because of increased capex from the producer, which gets us service people busier in more activity. So, but and I think we've talked about this at length before. Those other parts of the asset mix are growing too. It's just our power division is on turbo growth. So more of our capex is being allocated, obviously, to the turbine expansion in the fleet. But we do have a few $1 million worth of growth capex outside of the power division. We can't ignore that because the site infrastructure business is in these packages. It's power plus those other items that I explained. That makes up a site infrastructure package. So we're not just power, we're the whole package.
I'll do one more that I think is really important, and then maybe we'll open it up, and I have more that we could get to. But I think maybe the most important, at least from my opinion, is the IRR on not just turbines, but your other equipment. So the turbines, the electrical grid, and I know you don't want to tell the exact numbers, but can you run people through what type of returns you're getting on these investments?
Yeah, and I'm gonna describe it in very simple terms. These turbines are a $750 to $900,000 expense. Just the turbine. If we're buying one that's coming off a lease and it's got a few hours on it, but obviously we're gonna get a lower price. But a new one on the manufacturer's floor is about $900,000. The associated microgrid of cabling and distribution panels is about another $250,000. We build that in house. Now, the turbine, in simple terms, pays back in about call it 17-ish months. So it's pretty quick. In our world, in the equipment world, that's a pretty quick payback to get your revenue back that you expended. The cabling and the microgrid pays back in like 100 days. It's very quick. So as they go out together as an associated package, you've got a pretty darn good return happening with that power plant and the associated microgrid. Now, the majority of the other parts of the asset mix are all a mixed basket. Some of our lighting towers and what have you, they pay back in half a year, 7-8 months maybe, in revenue back in the till. The mobile structures are probably the longest payback. They're more like 30 months. But you need the structures to complete the package, right? Those mobile structures, the offices, the command centers, the medic building, that kind of thing.
Adam, do you want to jump in with some of the questions Q&A, or do you want me to keep going here?
Yeah, go ahead with another question or two, and then we'll take some from the audience. Thank you.
Okay, I think one is you just completed, a $28 million equity raise. So, let's talk about, uses of capital. I know you've done 9 M&A deals in the past. So obviously you're buying turbines and you're buying equipment, but, if there was M&A, what does that look like?
Well, as you mentioned, we've made 9 acquisitions and a couple of dispositions over the years. We do have an appetite for expansion through acquisition. We're always looking at something. We do have a couple of opportunities in front of us that we like. We're doing some work. We're it's not something that's going to happen by Friday or anything, but we are working on. We're always working on something. It's got to meet some pretty stringent criteria. Right now, it's kept our attention, so we are working on some opportunities in front of us. Some that will advance the power division. Some items that will that we're looking at will advance some of the other related infrastructure. But yes, it's a fair bet to think that enterprise will have some acquisitions in its future.
To keep going, so this might be more of a wide-ranging question as I get going, but Trican just reported this morning, and they're an energy service company here in Canada. Really good numbers, blew guidance kind of out of the water, or estimates out of the water, and they're talking about they're going to continue to upgrade their fleet, especially electric fracking. Which maybe you want to speak to one, electric fracking in the sense of what that could do to your business, and then get into maybe what mining or data centers could be down the road.
Yeah. Well, Trican's a very interesting name, because there is some demands that they have in their mix, and they've been having some problems on solving those power needs. So we've got some early collaboration with them. But there's no doubt the electric frac end of it is a natural extension of what we do already. So we are looking, and of course that's where that 2 megawatt unit comes into play that Flex also builds. So those are higher power needs. That would be an absolute extension of why we would start building the 2 megawatt unit. Electric fracking could be anywhere from 5 to 15 megawatts on a site. So you can see there are much higher power demands, but obviously we have access to the potential fleet to mount that. But one of the things that that end of the industry is having some problems with their solutions is reliability on the power. What's happening in most cases is they're utilizing natural gas reciprocal engines. So basically a Caterpillar engine that's not diesel, it operates on natural gas, but it's a reciprocal engine, it's pistons like your car. I've told you, I mean, before we found the Flex unit, we were building up, reciprocal natural gas fired power, and that's how. But we found that the reliability just isn't there. Well, they're having the same problems, so they're coming to us saying, because when you're fracking, your power cannot go out. I mean, it can't go out. So you have to have primary and a backup to the backup. So they cannot run out of power in the middle of a frac. It's millions in a hole, no pun intended. So reliability is an issue, and we're starting to speak to these entities about that and how we can help them with A, the power, and B, the reliability.
And then maybe just quickly speak to potential mining. I know you've had some conversations with using this technology in mining across Canada.
Yeah, mining is really no different. It's let's face it, it's a project out in the middle of remote areas and in the worst of conditions, and the incumbent is diesel in the mining industry. So the opportunity is there. Obviously, they're not producing natural gas on site, so we would be utilizing the compressed natural gas mobile vessels, which is still a 60% savings to diesel. But let me tell you, the few conversations that we've had with some mining leaders, and I know you and I have talked about this, Jesse, but for the purpose of the audience, is that one thing I realized in those two conversations is the mining industry is very hungry for better practices in the field. They want to show that they're making advancements in better environmental practices, emissions practices. So when I described our mobile power systems to these two mining CEOs, they knew nothing about it, and they were very enthusiastic about showing the outside world about better practices in the field. And one of those conversations happened about 2 weeks after the Victoria, in Yukon, the Victoria mine had that a rupture in a tailings pond or whatever, and all hell broke loose. So it was at a time where it was the last thing the Canadian mining sector needed was another disaster. So anyway, we fast forward, we're getting to a point where I can most likely say that we'll enter into at least a pilot project this year in the mining sector. And I think that'll be something that ourselves, the mining sector, and I'm sure investors in the resource sector will like to see how that pilot project goes, because I think it'll be a needle mover going into the mining sector here in Canada. But there's also I'd like to tell you that our new VP of Business Development, we're in some approval processes with two major utility companies here in Western Canada. As we're growing, and areas that don't have highline power out to those areas, it could take any of these utilities several months, or even you can even count a year or two, for them to get the power lines above ground out to certain locations where they're developing or building or what have you. Well, when the utility tells a client that they can't have overhead power out there for 7 or 8 or 9 months or a year and a half, it gets pretty owly. So we're an opportunity. We're now working on 2 approvals to be a vendor, an approved reference vendor to these 2 utilities, where they can actually get going out there without highline power, using our systems as temporary power until the infrastructure is built out to site. So this is a newer application that, Jesse, since you and I have talked, is a newer application for us. But I think on one of the utilities, I think we're complete the way through the approval process for the one, and we're working on the other. And they're recognizable names. They're utility companies. So these are opportunities that are showing themselves. You mentioned data centers and so forth. Well, one of the things I like to talk about is here in North America, we have an electricity grid across North America that is degrading every day, every week. We are not spending the maintenance capital to maintain these grids. At the same time, our societies are asking more out of the grid. Before we even talk about AI data centers, everything is being plugged in. We're asking more from our grid. It's not capable of. So as demand goes up and grid quality goes down, and as we move through time, we're going to have more and more and more disruptions. They're infrequent now, but they will become more frequent as we ask more of the system, and the system is degrading. So we look at our solutions as companies or manufacturing facilities or any business that can't afford to be disrupted in power. They should start looking at self-powering themselves, because we have a natural gas grid across North America that services 90% of every building that you walk into as natural gas. So there's an opportunity. And when have you seen a natural gas line go down? Right? So there's an opportunity to self-power with our turbine technology, small or large, and we have the cheapest natural gas in the world. We had a call with a French investor group earlier this morning, and we're talking. They're sitting in Europe right now with massive power prices, massive LNG, liquid prices for natural gas. Right now, Henry Hub is just over $4 US, which is, in the scope of the Henry Hub, that's high. Well, gas right now is $2 Canadian here in Western Canada, or in parts of Canada. It's $2 Canadian. It's the cheapest natural. It's the arbitrage from to utilize natural gas in industry is massive. Before we even start talking about AI data centers and the computational power that they're going to need for power. And as you've been hearing, they feel in North America that's going to come from natural gas. That was a long answer. Sorry about that.
No, that's perfect. I could keep going, but Adam, I'm going to let you jump in if you want to go through some of that Q&A.
Yeah, thank you. Really appreciate all the great questions and thoughtful answers. So we probably have time for one or two more, and I'm curious if we can just get into the makeup of the current fleet and the percentage that is flex energy. Is the intention to get to 100% there? If not, why? And then maybe if you can just talk about your plans to help flex energy down in the US with maybe a more aggressive strategy like you've done in Canada.
Uh, Actually, the internet just kind of cut there. Can you just say the last section of your question?
Yeah, can you hear me?
Yeah.
Sure. The second part was surrounding your plans to help flex energy in the US with potentially more aggressive strategy like you've done in Canada.
Well, we have at the moment we have zero intent in the American market. We've got tremendous runway here in Canada, both in the energy sector and, of course, these adjacent industries we talked about. You know, mining, temporary power, utilities, all of this. We've got lots of room to grow in Canada. It would be an absolute mistake and a distraction to start thinking about the U.S. market. There's plenty to do here in Canada, and of course, we've got a route here, a 20-year route of quality reputation in the energy sector. So we're going to stick to the Canadian region of North America.
Great. And then just thinking about the economics surrounding larger turbines versus micro turbines, can you just talk a little bit about the similarities or differences as you expand into that product line?
Yeah, and I hope I mentioned that clearer before. There's actually nothing different between a microturbine and a turbine other than size. There's a classification of half megawatt or 500 kilowatt units and below are classified as a microturbine. All of our flex units are 333 kilowatt units. That's the model that Flex manufactures. So that's the dominant in our fleet. The 2 megawatt unit, we have yet to bring one in the fleet, but there's a few things happening in the background that are developing that we could probably see 2 megawatt units in our fleet towards the end of the year or first part of 26.
That sounds like a great place to wrap it up. And once again, really appreciate your time and all of the comprehensive details surrounding your businesses. And thank you to all the participants. As a reminder, once the recording is available, we will have it up for distribution so you can watch the replay of the business breakdowns. And Des and Jesse, just want to say thank you very much again for taking the time to do this.
Thanks
Great.
again.
Thanks for having me.
Thank you, Jesse.
Thanks, Scott.
All right, thanks. Have a great rest of the day.
Cheers.